Hey everyone, for this section we're going to be discussing Deckers Outdoors internal analysis, covering their SEC filings, a full ratio analysis, and external research to get a picture on strengths and weaknesses. So, starting with the SEC filings, the story is straightforward. This company is growing. Hoka net sales grew over 16% and UGG climbed 8% with international sales expanding over 27% and picking up a lot of the slack from a softer domestic market. On the DTC side, Decker now operates over 200 company-owned retail stores globally, making steady progress towards that 50% DTC penetration goal Madison covered. One thing worth flagging is that gross margin dipped slightly, with the company pointing to incremental tariff costs as the main driver. Not alarming yet, but it connects directly to the political risk from the macro analysis, and it's a number to watch. On a positive note, earnings per share jumped over 13%, supported by an active share buyback program. They also phased out Colabora and Anu to stay fully focused on their two core brands. For the ratio analysis, we compared Deckers against 5 publicly traded rivals: Nike, On Running, Crocs, Wolverine Worldwide, and BF Corporation. Worth noting, this differs from some competitors Kel covered, since several of those brands are privately held. We also tracked Deckers' own ratios over 3 years. For liquidity and solvency, the headline here is what some analysts have called a bulletproof balance sheet. Deckers holds $2 billion in cash and carries zero high-interest debt. If every retailer stopped paying tomorrow and sales went to zero, Deckers could still cover all their short-term obligations, nearly 4 times over. Their current ratio is 3.7, is well ahead of Nike at 2.2 and Crocs at 1.27. The quick ratio sits at 2.89, meaning that caution isn't buried in inventory either. Meanwhile, BF Corporation has a quick ratio of just 0.65 and cannot cover their bills without first selling off stock. On the debt side, Deckers' debt-to-equity ratio of 0.4 contrasts sharply with BF Corporation at 5.30. For every dollar Decker owes, shareholders own more than 2. At BF Corp, creditors own 5 times what shareholders do. Deckers is essentially a company that owns itself, meaning every dollar earned goes toward growth or back to investors. The efficiency ratios told us that they turn sales into cash every 23 days. BF Corporation is waiting nearly twice as long to get paid, which creates a constant cash flow drag on their operations. On the inventory side, Hoka and UGG are moving off shelves fast enough that Deckers' inventory turnover trails only Crocs in the group. Know that stock sitting in warehouses quietly losing value. And for profitability, this is where the separation becomes dramatic. Imagine lining up every major footwear company and looking at how much profit they keep from every dollar of revenue. Deckers keep nearly 20 cents. Nike keeps 7 cents. Crocs and BF Corporation are in negative territory. That gap is not a rounding error. It reflects a completely different business model. Return on assets tells a similar story. For every dollar physical stuff Deckers owns, whether that's a warehouse, store, or inventory, they generate 29 cents in profit. On Running generates 8 cents, Nike generates 9 cents, and the return on equity of 42% nearly doubles Nike's 23. And what makes it especially impressive is that Nike leans on debt to inflate that number. Deckers earns there without any of that leverage. Looking at 3 years of trends, gross margins expanded from 50% in 2023 to nearly 58% today, and profit margins climbed from 14% to 19%. The one flat spot is asset turnover at 1.5. The company is getting more profitable per product, but hasn't converted that into greater efficiency from its physical footprint yet, something to monitor as the store count grows. The major strengths are brand power, industry-leading profitability and shareholder returns, premium pricing power, and a DTC model that keeps margins high and brand image tightly controlled. A notable minor strength is rapid international expansion, which has been a real buffer against the sluggish domestic retail environment. The major weaknesses are brand concentration, with Hoka and UGG accounting for about 95% of revenue, leaving no safety net if either brand loses momentum, and supply chain fragility, with roughly 80% of manufacturing in Vietnam, and no easy path to diversification. That Vietnam exposure ties directly back to the tariff risks we covered in the macro section. So, what does this all add up to? Decker's core competence is their ability to take highly functional niche products and scale them into mainstream cultural staples. Hoka solves a problem for runners. UGG delivers real comfort. That focus creates the kind of brand loyalty that supports full price purchasing year after year. And that pricing power is what drives gross margins around 60%. The engine behind all of it is their DTC model, which lets them control the brand experience, protect those margins, and stay close to the consumer without depending on wholesale partners. Add in $2 billion in cash and zero high interest debt, and they have the freedom to keep outspending rivals on research and development and international growth, even when the economy gets difficult. That combination is genuinely hard to replicate, and the numbers back it up.